Bear markets, declines in your investments, they can test your stamina as an investor. Even worse though, if you're in retirement, how can you invest successfully in retirement despite a bear market? I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, it's certainly been a turbulent year in the stock market this year, and honestly, this should happen every 4 to 5 years. Now, we've had the extreme environments of the COVID recession, but other than that, there hasn't been a lot of volatility, not like this, going back, to 2008, 2009, and 2008, 2009. So we haven't dealt with a prolonged pullback in the stock market like we're dealing with right now, and it's coming at a time when more and more individuals have recently gone into retirement, either because of COVID or because they saw their investment surge or they were just ready at that age. And so how can you invest successfully in retirement despite a bear market and a volatile stock market? You got to follow these 3 tips. Number 1, you've got to avoid reversed dollar cost averaging. That's right, avoid reverse dollar cost averaging. Now, before I explain reverse dollar cost averaging, what's dollar cost averaging? Well, while you're working, you should be contributing out of each and every paycheck a certain amount going into your 401k. And one of the benefits of doing that is, say that amount totals to $1,000 a month. That's going out of your paycheck into your 401k. Well, that $1,000 a month going into your 401k is buying shares. And as the stock market goes down, those shares are worth less, meaning your $1,000 can buy more of them. So over time, by consistently investing each and every month or every 2 weeks or periodically, you're able to buy more shares when prices are low. And because the stock market's moving all the time, going up and down, in those moments when the market's going down or has gone down, whether that's just for that week, for that month, for that quarter, or for that year, you're buying more shares at lower prices. So when they rebound, you've got more shares that have been purchased at lower prices and rebound quickly, okay? That's dollar cost averaging. On average, it means you're buying more shares at a lower average price. The reverse is very painful. While doing that is very beneficial while you're saving up, the reverse of that is awful. It's the worst thing you could do. What I mean by that is, if you then, instead of investing $1,000 a month, what if you need to withdraw $1,000 a month? Well, if you're needing $1,000 a month, that means you have to sell more shares when those prices are lower. It's the exact opposite. You get instead of the benefit of buying more shares, you get the worst result, meaning you're having to sell more shares when their prices are temporarily depressed. So you want to avoid doing that in retirement. Well, if in retirement you need to supplement your Social Security, you need to draw money out of your investments, and you shouldn't do this reverse dollar cost averaging, what's a better approach? So avoid reverse dollar cost averaging and instead invest in buckets of money, okay? So therefore, we call this a personal pension plan. The dollars that you're gonna need over the next 2 to 3 years should be in very, very low risk investments. Therefore, they shouldn't be fluctuating that much on a daily, weekly, monthly, or even annual basis, so that as you're pulling your $1,000 a month out, you're not having to sell investments at low share prices, okay? So that's your short-term bucket. Your intermediate term bucket is the money that you'll need, 5 or so years after that. That should be an income producing investment or balanced investment, something that is taking some risk, so there's some growth or interest that you're earning, but you have and not as much volatility, there's not as much risk as the overall stock market. And then the money you won't need for 10 plus years should be in that furthest bucket, and those dollars should be invested in a diversified portfolio, hopefully a diverse, diverse strategies as well, so you get even more diversification. But that money should be riding with the ups and downs of the market, okay? So instead of a reverse dollar cost average, which is very painful, means you're selling more shares at lower prices, the exact opposite of what you want to do. Transition instead to a buckets of money approach or personal pension plan. I did a video recently about the dangers of target date funds this year and in retirement. This is one of them. If you only own a target date fund and you're selling those shares on a consistent basis every single month so that you can get your retirement income, you're doing this the exact wrong thing. That's reverse dollar cost averaging. Avoid that. Go with a personal pension plan. Work with your CFP on that. Now, the second tip for successful investing in retirement is don't abandon risk. Let's go back to that buckets of money, that personal pension plan. Now, in order for you to sleep safe at night and have confidence that you've got enough retirement income from stable sources, know that you're drawing dollars out of that low risk investment. That's great. That's your short-term money. Your intermediate term money, just in case the stock market has a severe drop and it takes several years to recover, your intermediate term money shouldn't be taking that much risk, and it will have time. You're giving that time to recover. But your 10-year plus money, that final bucket, those are the dollars you're not going to need for at least 10 years, maybe 15, maybe 20. And therefore, their job isn't to avoid ups and downs in the market, it's to beat inflation. It's there. That's the money that you need 10, 15, 20 years out when likely inflation has eroded your purchasing power. Therefore, how do you keep up with inflation? How do you beat inflation? While it's risky, and it's not, it has its ups and downs. It's got lots of volatility. The stock market is what has beat inflation the best over time. Therefore, the money that you don't need for 10, 12, 15, 20 years should still be invested for the long term. That doesn't mean you need to be speculative or you need to put it in cryptocurrencies or you need to put 100% in stocks, but your 10 plus year money should be in a diversified mix, so you're managing away any non-systemic risk out there, and that it's still structured in a way that it can grow and appreciate and combat inflation over the long term. So the second tip for successful retirement investing is realizing you're not going to spend all your money in the short term. The money that you need for the long term still should be taking some risk, so don't abandon risk. How that all shakes out in your entire portfolio will depend on how that works and the math and the strategies that you work on with your CFP. But for many individuals, at 65 or 70, your total portfolio is probably about 50% in low risk and bond type investments and 50% still in a diversified mix of stocks. When you look at how much is in that short-term bucket, how much is in that intermediate-term bucket, and how much is in that long-term bucket, approximately 50-50 when you're in your 65, 70, something like that. Maybe even 60-40. You still have some stock-type long-term investments in that 10-year plus bucket. Work with your CFP, do the math, figure out that strategy for you. And then the final tip for successful investing in retirement is to do tax planning. It's to manage your taxes. Oftentimes, people erode their overall return by paying too much money to the IRS, to Uncle Sam, just simply because they weren't being proactive with their overall tax strategy. The opportunities that exist during retirement to strategize with your taxes are significant. Therefore, your certified financial planner, your guide, the individual that's helping you manage your wealth and your finances, navigating through retirement, should be an expert in taxes, should know your CPA, and they should collaborate with them. Is now a good time to do a Roth conversion? Is now a time to avoid taking extra money out of your IRA because it would cause more of your Social Security to be taxed or cause you to be in that next tier for IRMA, paying more for your Medicare Part B and Part D? Should you do any tax loss harvesting on other dollars? Where should you have your growth type investments? How should you structure your Roth investments? Those are the type of tax strategies that if you're not mindful of those, it can mean an extra $100 there, an extra couple thousand here that you're paying in taxes that otherwise, that's money that's going to Uncle Sam and it's not staying in your portfolio, growing compound for you for the long term. That can erode your investment portfolio significantly over time just by not being mindful of the various tax strategies that you can employ to pay the least amount of tax over your lifetime. So those are the big 3 tips to help you invest successfully in retirement. Avoid reverse dollar cost averaging. While you're working and saving up, you do want to take advantage of dollar cost averaging. But when you retire, don't just sell a little bit of your stock investments every single month to get your income. Instead, do a personal pension plan, a bucket of money. That's number 1. Second one, don't abandon risk. And again, that personal pension plan will help you solve that as well, where your short-term dollars are safe and steady. So when Jim Cramer is on the Today Show in 2008 saying, everything's crashing. You should have 2 years of your money sitting in cash. You already do. You don't need to worry about that, right? So don't abandon risk. It's your 10-year plus money that should be taking some risk and some investment risk because it's got a different job. Its job is not to avoid volatility. It's to beat inflation over the long term. Stocks do that very, very well. And then finally, number 3, do tax planning. That can significantly enhance the return that you'll see on your investments over time in retirement so that you can pay the least amount of tax over your lifetime. Each of those and any other successful tips for investing in retirement that's the job of your certified financial planner. They're going to work with you, strategize all of that, help you navigate how you should manage your wealth and taxes and income through retirement. Work with your CFP who's doing comprehensive financial planning. If you don't have a CFP on your team that's doing that, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.